Good morning, good afternoon, and good evening to you all, one and all. This is the Smoking Barrel. I'm Rustin Edwards, based in Geneva, with my casually dressed, clad co-host, Mr. Matt Stanley, in Dubai.
This
You
is
just rolled out
smart.
of bed today, or what?
No,
Going
this
to the
is
gym?
smart. No,
That's smart
absolutely.
casual, eh?
Yeah, well, look, I mean, yeah, I work from home majority of the time, and I always try and look smart, but this is about as smart as it gets. No, I wear a shirt sometimes, you know that. But yeah, welcome from Dubai. It's 2nd of September. We are two-thirds of the way through the year, which is unbelievable. And the weather's starting to get better in the Middle East. So no complaints my side. How are you?
We're rocking and rolling and whatnot. As you said, we've got August has rolled off the board. We've got crude oil markets trading to the lower side of the range. A lot of that being driven by the headlines that popped out over on Friday, as well as other data that came out over the weekend, which we'll talk about as we move through the program here today. But
Yeah,
Nonetheless, things are good. Things are wonderful. Kids back in school. APPEC about to take off,
yeah.
and we got front month Brent at 76.75.
We have, yeah, look, some admin. So Russ, we did mention this in a previous episode. Um, Edwards, you won't be there in Singapore this year.
No, there'll be no presence of the Geneva branch of the Smoking Barrel in APPEC this year.
Yeah, it will just be smoking as opposed to barrel as well.
Hey, I have put on a little weight. Come on now.
Yeah, tell me about it. No, it's you're away. You got commitments. I'm looking forward to seeing, catching up with old faces. I mean, I'm in Singapore quite a bit, fortunate, thankfully. But yeah, the whole oil market and not so much freight, but a lot of people in that sector and the energy industry are there. Yeah, descend on Singapore, and it gets earlier. I mean, some people are starting their parties on Thursday night now. I mean, it used to be just sort of a Monday to Friday thing, or not even Friday. People are usually saturated, let's say, by Thursday breakfast time. But yeah, now it starts the Thursday before and ends on a Thursday evening. So it's a whole week.
Oofa. Oh my. Yeah, I'm glad I'm leaving my liver here in Geneva.
Well, I mean, that'd be good. It's I suppose people are, the irony is that energy markets, if you were to read the press, have been seen to sort of consolidate in the last few years. We've seen a lot of that from a corporate point of view in the States. Chevron buying Hess. A lot of the upstream producers, Devon and that. But you know, the market is still growing. It might not be, there might be less players, but the players who, the traders and the majors who are there are ever more active in, including the new ones, like the likes of relatively new of ADNOC and Aramco and SOCAR. They're very much sort of front and center. So yeah, it will be a busy week. Don't feel too sorry for me though.
Well, I'd have to think that a lot of the people are going to be sniffing around to see if Dangote sends a representative group to APEC in Singapore, and probably a lot of sniffing around as to how things are going there, because stories out today say that they're ready to start making gasoline. They're just waiting on government approval to accept gasoline. So you can take that for face value for what it is.
Yeah.
Um, Nevertheless, that's typically going to, or that's scheduled to be probably one of the biggest shakeups in the Atlantic Basin oil trade if that does kick off and they can stabilize and get moving at a regular flow rate, because that will not only impact West African flows coming in, but also material for refining margins in Europe and potentially U.S. Gulf Coast as well.
Yeah, absolutely. And it's, look, I said before and earlier on in the summer, I hosted a webinar on Dangote, what's going to happen. Look, it's a tough one, isn't it? Because like you said, it's such a sort of disruptor for how the Atlantic Basin has traded, whether both feedstocks and the products coming out, that people have been a little less welcoming of good news. Should we say that? And that's the polite way of saying it, but it has been difficult. It's such a big unit, so many eyes on what it means. Not just for Dangote, but Nigeria or Lagos, and then Nigeria with the new, President Tinubu is already a year into power, and he's seeking to settle that landscape, more and more. They're trying to get their Port Harcourt refinery going. They're trying to get Kaduna and Warri. That's a difficult thing to do because fed by pipe, that has been sabotaged over the last couple of decades, which is why those two refineries haven't run. But, all eyes being on Dangote, when they do run into problems, let's say the existing competition are quick to jump on it. So it's been a tough gig. It will be interesting to see if they end up in Singapore. I'm sure they will, because they need that conviviality. They need the sort of to interact with their peers and do whatever.
Well,
And
the East has been a big outlet for a lot of their material, the straight run material they've been producing. The naphtha and the fuel
yeah,
oil seems to
yeah,
be heading to the Far East on a regular basis. So, if they're there to join up with people who are still buyers of that material to see what's going to happen, I mean, you obviously want to make a presence that happen. But I think the quiet thing about Dangote being the big beast of the West African market, you still have the Soweto refinery, that has kicked off, but you don't hear too much about her and what she's doing and how much they're producing. You have Angola with their new refinery project as well that's supposed to have kicked off production at least this month, or I believe it's next month. But again, that's
yeah.
only 30,000 barrels a day, not massive, but that's going to expand to 150 to 200,000. So, it is the harbinger of things to come, I think. I think West Africa is going to become a major refining hub and will upset the entire trade balance and rejigger trade flows once again. And we'll probably see that more and more in 2025 and 2026.
Yeah, look, I mean, my colleague Victor, he wrote about this. Let me just share my screen when I can. The other disruptor we kind of see, in the refining landscape has been the new one in Mexico, the
But
Dos
focus.
Bocas refinery. Yeah, exactly. We've seen, when I can share, I'll show you. But we've seen a marked drop in Mexican seaborne crude exports over the last sort of few months, and you can kind of see the way that that's going to going is that Victor argues that the baton of market interest will now pass on to Dos Bocas from Dangote. So is there less focus on Dangote? I'm not sure, but I think the market is largely priced in. We still don't think that Dangote refinery produced finished grade gasoline for internal consumption until Q1. Maybe that's a little cynical, but it's very much in the move on to the next one, which is right. Okay, so this one's what's happening at Dos Bocas. It's largely been, people have been skeptical about it because obviously, whereas Dangote is going to affect the European market, it's going to be, in terms of gasoline blending and who's going to buy it, and the Nigerians still going to be there to buy it. They will still need some, but Dos Bocas is certainly one where the Mexican Mexican imports drop off from the US Gulf Coast, so it affects a different part of the market. And Victor goes on to argue here. You can see kind of where it's been. So we've got a flurry of news from Dos Bocas has indicated this year it still sees a notable improvement in Mexican runs by Q4. So yeah, look, it's all change, isn't it? It's all what's going to happen.
Well, the interesting thing about the changing landscape of the Mexican refining sector is the fact that not only have Dos Bocas running up, but you have two large coker projects, which are going to kick off next year as well. And so when you think of refinery yields, Mexican production primarily being heavy sour crude oil, and a lot of the
Yeah,
refineries are geared up to run heavy sour crude, thus produce a lot of high sulfur fuel oil. From a global balance standpoint, if the cokers kick off, give them a month, 2 month delay from when they're scheduled to come off, plus the Dos Bocas refinery, you could see
yeah.
a significant tightening in U.S. Gulf Coast high sulfur fuel stocks in 2025, rolling into 2026, which could therefore up in the entire balance. And I think if you look at the forward high five curve, the market's pricing that in already. I mean,
Oh,
you
really?
go from $100 high five here in the prompt to a $55 high five in 2026 in Singapore or an ARA. And the market is dictating that we are going to see lower high sulfur fuel production coming into in the next 18 months.
That's interesting. That's one to keep an eye on. I mean, is that Is that also because demand for ships fitted with scrubbers continues to go up, continues to increase?
Well, I think the scrubber fitted economics are probably flatlining at this point.
Okay.
Um, because when you look at energy transition in the shipping market, okay, you're building a new ship, most likely it's going to be scrubber fitted dual fuel. Are you retrofitting anymore? Maybe, maybe not. It really depends on what routes you're on and what's going on. And you also have the couple that with the um, uh, discharge effluent regulations that seem to be getting more stringent in certain markets, thus limiting the ability of scrubbers to operate within 200 nautical miles of different countries.
Yeah.
But nevertheless, I think the interesting things about 2025, you want to look at shipping and disrupting, and not that we're going off on a different course here, pardon my pun, but we do like to chart different locations and different routes of how markets can react.
Yeah.
And the big waypoint that we're going to hit in 2025 is going to be May 1st when the Mediterranean ecozone for sulfur kicks off.
ECHA being emission controlled area.
Yes. So when you look at today, you have three major sulfur emission control zones. You have one off the coast of China, which is basically coastwise China. You have the United States, which is 200 nautical miles off any United States territory or region. You have to burn zero point 0.1 sulfur emissions. And then you have Northern Europe, which is also a zero point 0.1 sulfur emission zone. And now you're going to add the Mediterranean as of May 1st of next year, which could cause a major disruption to the whole supply and demand balance of fuel oil versus that of gas oil. But again, that's in the future.
Oh, but it's, that's quite a, you're talking about Gibraltar, falling under that region. That changes the landscape there on supply and demand, like you said, quite significantly.
Well, when you think of on the demands profile, so it doesn't necessarily it will impact bunkering that's done inside the Mediterranean, but probably the bigger impact is what's going to be the knock-on effect to other markets outside of the Mediterranean, where ships are transiting from, say, Rotterdam into Genoa. Well, now they're going to bunker less fuel, more gas oil, because they know they're going to have that leg into Genoa, back out of Genoa. If you have any ship that's transiting from the opening of the Straits of Hormuz, or sorry, I said not Straits of Hormuz, excuse me, from Port Said at the
Yeah.
northern point of the Suez Canal, transiting through the Mediterranean. So you have to start thinking of that cost benefit relationship if you're burning a more expensive fuel to make the transit through the Med or versus going around Africa.
Yeah, there you go. I mean, look, moving on just quickly, but in the same breath, you stumbled upon it there. The Straits of Hormuz and Bab el-Mandeb. Let's just move on quickly, just onto something my colleague wrote about as well. Not that I'm stealing my colleague's work. I mean, nothing new there. But my colleague last week, Homoyun, is it time for the market to reevaluate its geopolitical risk premium? Discuss, Edwards.
I think so. I think the market's been putting way too much in geopolitical risk. Markets have rebalanced. I mean, it's still there. There's still geopolitical risk. There's also apolitical risk when you think of Venezuela and what's going on post-election and the Maduro regime keeping an iron fist on control, despite what people might say about the actual results.
Yeah.
You've got the U.S. election coming on, which could be a wild card on what happens with sanctions regime as well as internal U.S. production when it comes to, is it Harris? Is it Trump? Is it green agenda? Is it not a green agenda? Is it drill,
Yep.
baby, drill, or is it refrain from drilling? Circle back into the Middle East and what's going on in the Middle East. People had been waiting breathlessly for an Iranian response to the murder of the Hamas leader, the assassination of the Hamas leader when he was in Iran, tending to the inauguration of the new president there. Yet nothing has happened, and so it is a point where I think people need to start reevaluating geopolitical risk and where does the risk actually sit versus not perceived risk based on past paradigms.
Yeah, look, I mean, this is the point, isn't it? Because this is where the discussion is good. Because are we saying that the market overpriced war risk premium? Are we saying there's not enough? Are we saying that the market is now sadly, as it has done with Russia and the Russian conflicts and Ukraine, and the Ukrainian conflict, has it largely settled around these levels and that's largely priced in? Or are we saying that there's perhaps more to come? Homily says here, traders.
I would think that war risk premium is all priced in. And I say that because where is actual supply being impacted to the market? And that's mainly in Ukraine and Russia.
Yeah,
Just what happened over the weekend, Ukraine struck the Moscow refinery from Gazprom. So if anything, you've got probably far more activity in that realm, which is impacting actual supply to the market on both refined products as well as crude oil. So that kind of justifies a real war risk premium. The war risk premium around what's going on in the Middle East is a purported war risk premium, because I think everybody looks at the Middle East under an old paradigm that,
yeah,
oh, you're going to have OPEC is going to do something because of what's going on in Israel.
yeah,
Iran is going to do something because of what's going on with Israel. And I think the fact that it's very difficult for Iran to actually do anything without losing a lot of material, because for Iran to do anything to impact Israel, they got to overfly a lot of airspace that's not under their control or under Allied control. And that becomes very difficult, especially when you think of Jordan, Saudi Arabia, Kuwait, Iraq, any place where U.S. military ships are floating. So there's
yeah.
no way that they can actually really effectively strike Israel directly. And I don't think it's in Iran's best interest. And I think they don't think it's in their best interest to try to shut down the Straits of Hormuz without stirring up a larger pot that they don't want to be contending with. So I think the whole Middle East war risk premium is way overdone from where it could be. And the actual war risk premium sits more and more with what goes on with the Red Sea
Yeah.
and the Straits of Bab el Mandeb, because that's where the Houthis are actually physically attacking tankers and attacking ships and reducing transit flow through that region. And you have the impact on Ukraine striking Russian oil infrastructure.
Look, it's again, we come down to news values, what they're worth. It's not going to constantly move the market in terms of energy security. What's happening it's nearly a year. I think it was October last year that we really saw tensions increase in between Israel and Gaza. But with the moral compass on, firmly on, you over 50,000 people have now died owing to this conflict in mainly in Gaza, compared to around, I think it's around 35,000 people between Russia and Ukraine. I'm not saying,
Well,
I'm not
I think it's far more
trivializing
than
that.
35,000 in Russia and Ukraine. I would say that you probably have close to a million people, military, non-military, who've probably been impacted by the Russian-Ukraine conflict.
Yeah, no,
Uh,
I'm looking in the prism of unfortunate deaths, and it's
yeah, well, I mean, the death, who knows how many deaths have happened? I mean, a missile hits a shopping center in Kursk, versus and that's been going on for over 2 years now. So I think the people probably get desensitized to it,
yeah.
where Gaza's a bit more recently in the face.
Yeah, and this is the grim reality, is that I think you're right. Just going back to what it means for risk premium, it's how much is perceived international response worth in oil markets, right? You're right. Iran haven't reacted. There was an escalation last week in a tit for tat missile attack between Hezbollah and now Gaza and with Hamas and Israel. If that escalates higher and there's a wider conflict, I don't want to say that the market has dismissed it, but I don't think it's front and center anymore. And I think that was keeping prices in that mid 80s. I think that risk premium there was keeping oil Brent futures prices in the mid 80s. We're $10 below the high now. There's other reasons which we'll go on to in a minute. Damn you, OPEC, apparently. But if we're talking about war risk premium, I'd say
Well, but I disagree with your assessment on where war risk premium is sitting. Flat price to me is more a relationship to the actual supply and demand um, of the world. You've got fairly weak oil demand, perceived forward weak oil demand. We're going into turnaround season. You're going into, China's manufacturing data came out fairly poor over the weekend, which is the
yeah,
sixth consecutive downgrade of PMI data out of China, the fourth consecutive month below 50. which shows you that Chinese markets aren't recovering at all, and they're not going to grow at the rate they wanted. We had the OPEC headline, as you said on Friday, or not the OPEC official headline, but the talks of people who cannot be named saying that the planned release of voluntary cuts will go on as scheduled. But I think when you actually look at the structure of the market, we're in a relatively weak flat price market with very high backwardation. And that's both in WTI and Brent. And so to me, the way that the market is positioning for war risk premium is not on a flat price basis, but on a structure basis. And so we have an extremely high backwardation, which, outside of anything else, you'd say, oh my God, there's no oil. Look at the backwardation. Markets should be roofing. You've got WTI has $1 backwardation. Brent has about 80 cents backwardation, M1, M2. And
Yeah.
you would think that that would dictate that we are in a very tight market, but we're not in a tight market. There's a lot of oil around. I mean, Libya shut in 1.2 million barrels over the last week per day of oil, and the market sold off. It didn't rally.
Yeah, that's right.
So
Yeah, look, I mean, I
markets are
think,
adequately supplied, but the
yeah.
risk premium is being dictated on where the structure of the curve is sitting, not so much in a flat price level.
Yeah, look, there's a couple of things I want to pick out there. Start with Brent structure. It was about $1.20, I think it closed on Friday. October, Brent expired. And I think in the end, maybe went higher to about $1.60, people rolling out those positions. Front month, well, M1, M2, 70 cents, Dec Jan 52. And then largely flattens out, March, April. Well, then you come into seasonality, you come into then maintenance season, and then demand increasing through the summer. And that was largely a buy when we said that there would be a deficit of supply versus demand throughout the summer. I think that will be a rinse and repeat from last year. And I think OPEC have got that firmly in their binoculars as well. Just going back to the other point that you were talking about regarding China, look, we've seen Chinese oil demand growth on products. So kerosene, gas oil, gasoline, gas oil, I said the other week, we see gas oil demand in China topping out in 2026. That's a discussion point I'm sure that will be had next week in Singapore for APPEC. But oil product demand growth this year in China is less than 1%, and the market really put a lot of eggs in baskets.
Everybody put their eggs into the Chinese basket. When you read all the analysts in Q1 and Q4 of last year, China was going to be the dominant demand leader for 2024.
Yeah. Yeah, you're right. I mean, I think I was looking at it earlier on. I think that, where is it? I think that I'll go on to it later on. I can't find it now. But I think the IEA had about 800,000 barrels a day of oil demand growth coming from China this year. I think OPEC were a little lower, actually. They thought it'd be other contributions from other people like India and US, etc., and parts of Europe. But yeah, looking back at the last sort of 8 months that we've had so far this year, Chinese oil demand growth has massively disappointed those who really put all their eggs in the Chinese basket, right?
Yeah. And, it's a contribution factor of low manufacturing, low industrial, construction is not doing too hot. Couple that with EV adoption and renewable energy increase. All that kind of cocktail kind of puts together a nice mix of lower overall oil demand going forward.
Yeah.
And the energy transition in China is moving ahead at a very, very quick pace.
Yeah, yeah, absolutely. Yeah, I mean, what you touched on it earlier on, but the story about OPEC, bringing back oil for October. That's when they plan to sort of roll back the production cuts that have been in place for over 2 years, and October is when they're going to start bringing back. I think it's about 200,000 barrels a day, something like that. I put in my commentary this morning. Did OPEC do that on purpose? Arguably, it might have done. I'm not saying that they're playing games at all, but I'm saying, did that sort of get leaked to test what the market reaction would be before they actually did something tangible? Arguably, yes, that did happen.
Well, I mean, I think if you look at OPEC and the commentaries that comes out of different OPEC members prior to any major announcement, there's always that test bubble that kind of gets floated out to see what happens in the market. I mean, if
Yeah.
it's one thing, if it's the Saudi oil minister saying, "Oh, we're going to manage price and we're going to do or not manage, we'll manage supply as needed to meet the market's demands." Things that generally are trying to be more bullish to see how much the market goes up versus something that's a bit bearish, see how much the market goes down.
Yeah.
However, the flip side, I think, with OPEC from a strategy standpoint, however, is that OPEC's problem is the fact that they need to get demand to stimulate. I read a piece in Bloomberg on this here this morning, so I'm quoting it, and I do forget the author, so please forgive me for that.
Don't
But
sue
nevertheless,
us.
the juxtaposition of that article is the fact that if OPEC continues to keep the market tight, market forces will push the market lower just because the demand's not there for this supply that is currently on the market. So OPEC either needs to cut more, which they don't want to do because that impacts the cash they get coming in. There's been too much cheating anyway against the current cuts. So they really can't cut more, they'll just simulate more cheating. So the net change in volume doesn't happen. Therefore, your supply remains constant and demand remains weak. Therefore, prices don't really go up. However, if you lower prices to a certain point by adding additional minimal volume back into the market, you can start stimulating demand because prices go cheaper. Remember, we're still in a high interest rate environment. So any marginal barrel gets bought today by a person, they're paying a very high interest rate to hold that barrel versus what it was 2 years ago when interest rates were flat.
Yeah.
So if you want to stimulate demand, lower energy prices, then demand will
Well,
kick in and that will drive prices back higher.
well, that also brings us back into the wonderful argument about market share. If oil prices stay at these kind of break-even levels for a shale producer in the States, then you lose market share by OPEC cutting, which means there's less production from their side, but you encourage more production from the States because they can make it work. So if oil prices do drop to say, I mean, look, I was listening to a guy on the radio this morning, Ed at Emirates ABD, what is the break-even price in the GCC core? For say the UAE, what do they need Brent oil prices at? He's saying at high 60s, something like that. Saudis maybe a little bit higher. But if you can balance fiscal budgets with where oil prices are, and that's not the dynamic of OPEC. That's not that they don't have an agenda apparently for high oil prices. They have one for balancing the market, which work hand in hand, arguably. But if you discourage prices, get to a point where new production is discouraged because it just doesn't work from an economic point of view, then that's also OPEC's objective as well. So I don't know. I think there's a lot more to go. I think there's a lot more complexity to this decision.
Saudi tried that strategy once before and they drove oil prices down to the 40s and it didn't work.
No, but I mean, the narrative that's coming out,
the thing with a lot of these U.S. producers, they have these wonderful things called hedges, which lock in their value. And so therefore, lower prices means absolutely nothing. It means they still produce, assuming they're still using hedges as a strategy to protect their production margin.
Yeah, there is that. Yeah, hedging. Yeah. I mean, I don't want to get onto that conversation. I don't want to ouch like hell. Prince Abdulaziz will come and find us. Anyway, before that happens, no, it's been nice. So no episode next week, but we'll be back the week after, right?
That is correct because of APPEC. So you'll be out enjoying some nice spicy noodles and some good beer along Boat Key out in Singapore, and I'll be enjoying some Manhattans in the island of Manhattan. So there you have it.
Yeah, no, it's good. Yeah, 76, 67 on Brent. So
yep.
I don't know. Let's see.
And one last thing here, we look at the old hurricane map because we're still 2/3 or 1/3 halfway through hurricane season.
Yes.
And if we take a look, we got 3 little tropical disturbances floating out there, one off the Gulf Coast, one off the Caribbean, and one off Africa. So probably one to take a look at is the one that's sitting off the Windward Islands. Because that one's probably got the best chance of causing any type of disruption if it continues to rotate and move to the west. The one off the Gulf Coast could develop, but I don't think I think it's interacting too much with land really to develop into anything major. And of course, the one out here in the west coast of Africa, most likely, if that does develop, will just end up in the middle of the Atlantic Ocean, not really impacting any oil supplies. So the one to really look at is the one down here off the Leeward Islands, see if that does anything.
Yeah, look, I mean, it's you know, just in terms of dates as well. I mean, hurricane season. This is the time where it starts to become more active historically. But Memorial Day in the States today, and that marks the end of
No,
driving
Labor Day,
season.
not Memorial Day. It's
No,
Labor Day.
sorry, Labor Day. Excuse me, I nearly had it then. Memorial Day is when it starts, and Labor Day is when it finishes, right?
So Labor Day is the end of driving season in the U.S. So
Yeah.
kids back to school, travel stops, but it's the last 3-day weekend. So get those barbecues rolling and enjoy that last bastion of summer weather.
Yes, exactly. But yeah, look, we'll be back in a couple of weeks, and we'll have a look and see what driving season look like. I think there'll be a bit more data out and see what OPEC do.
That's a big affirmative. So everybody enjoy your APPEC. Click like and subscribe. If you have any oil market tidbits, Matt will be there. I will
I'll be there.
unfortunately not be, but hopefully we'll have a live session of the Smoking Barrel in November. Come Dubai.
Yes. Yeah, we'll see. Yeah, absolutely. All right. Cheers, mate.
Click like and subscribe. Have a good one.